Hi, good morning or good evening to everyone, wherever you are. It's an absolute pleasure to see everyone here again. My name is Ian, and before we kickstart today's session, I just wanted to make sure that everyone can hear me real quick. If everyone can hear me, could you just give me a reaction? You can do a thumbs up or any form of reaction, really. That's fantastic. Hi, Hazel. Good evening to you. Thank you, Katie. See you, Alicia, as well. Donnie, if you can hear me, feel free to give me a thumbs up. You can give me a heart as well. I don't mind. And we'll be commencing real quick. All right. So once everyone's settled down, we'll be commencing today's session. And today we're going to do the deep dive with regards to digital sustainability. I hope all of you are hyped up and ready to go. But before we kickstart the session proper, Cassie or Katie, you guys have any opening words, or should I hop in straight?
Go ahead and hop right in, Andy.
All right, so I'll go straight into today's content. Okay. All right, if that's the case, then let's do that. I just want to kickstart today's session with a quick question, right? Does anyone remember what you guys learned the last time we met, right? If anyone can remember, I'm just gonna pop up a couple of questions right here, and in the interest of digital sustainability, as we call it, the slides for today are going to be slightly more bare than you might be used to seeing. Okay, so we're gonna session with a couple of questions, and I'd like you to either A, shout out the answer, feel free to unmute yourself, we're having a small group today, or B, I want you to write your answers in the chat box. Okay, so the first question we have for today is, what is digital sustainability? Does anyone still remember what is digital sustainability? Anyone wants to give it a try? Feel free to write in the text box or to basically unmute yourself and talk about what is digital sustainability. So we've got two questions. I'm just going to flash them out real quick right now. And the first question really here is, what is digital sustainability? And the second question is, what is a digital carbon emission? Does anyone want to give a shot at it? Going once, going twice. I see my deck is on the screen right now. So can anyone see my screen? No? Let me just try that one more time. Can anyone see my screen right now? That's fine. We'll just skip the question slides, but we'll have the main deck anyway out right here. Okay, perfect. This is the one. So today we are going to talk once again about digital sustainability, and we're going to do a hardcore deep dive into unlocking the power of digital decarbonization, right? The first question just now is in terms of digital sustainability. For all of you who may have an inkling, but perhaps not enough midnight coffee, let me just give you the answer. Digital sustainability is where we incorporate the principles of ESG into our virtual world. And digital carbon emissions are the CO2 that is emitted each time we use a digital product or service. Okay, so in today's session, we're gonna basically have a quick run through in terms of digital sustainability and how they relate to credit unions, and also things that really you can do throughout your work. So we have a fairly small group, so feel free to raise your virtual hand at any time if you've got questions. Feel free to just drop in any comments that you might have in the chat box towards your right-hand side. So I'm just gonna kickstart with some deep dives. And as promised, today we're gonna go a bit deeper into basically digital sustainability. How I frame this session is as such. We're gonna go through a bit more of in-depth theory towards the beginning portion. And then we're gonna have a short washroom break towards the middle of today's session before we reconvene after about a 5 to 10 minute quick break, after you've gotten your tea, your coffee. And then once we reconvene for the second half of today's session, we're gonna go into the specifics with regards to your particular credit union. So I hope you're familiar with your working environment, and at least you've got an inkling of what things are. We'll then be building piece by piece about actionable digital sustainability strategies we can bring back home, bring back to the credit union once we're done with today's session. Okay, so without further ado, let's go straight into things. And when we talk about digital decarbonization, one thing that was actually asked the last time round, but in which we didn't have much time to talk about, was hardware sustainability, right? So there is, of course, the computer code that we talked about the last session, carbon footprints of anything really, from WhatsApp messages to emails. But one of the things that we also need to talk about is a computer, right? So we're using computers right now. Some of you may be using more than one computer. You may be tuning in to today's session via a couple of screens. And what that basically means is that we've got what we call e-waste, okay? E-waste basically stands for electronic waste. And essentially, the concept is the more devices we have in our offices at home, due to the work from home previous orders, some places, some institutions may have two sets of computers, right? One set for the workplace, the office, and one set for the home environment. And what that basically means is that you've got more electronic waste when it's time to decommission those computers, when they get too old to function up to speed, when they start breaking down, when we start needing to basically put them into the bin, we've got an increase in e-waste. So how do we deal with that, right? And how do we ensure that the hardware side is also sustainable? The first thing really is extension of shelf life. And I guess that's something that most of us as very prudent people in the credit union space would already do, right? So instead of replacing devices every 3 years, every 2.5 years even, replace devices every 5 years, right? Unless it is a mission critical device that thrives on speed, right? Of which I think there would be a smaller portion of which right here anyway. Second thing is really recycling e-waste. And in different places, it really is pretty different. But generally speaking, there should be either a local company you can call to kind of pick up the e-waste, or better still, to recycle the e-waste, what you can do is to phone the local kind of like repair shops, right? The mom and pop shops who does local hardware repairs. If you're intending to trash away your old laptops, why not give it to them, right? Besides recycling, they might even use it for a bit longer. Sometimes they don't need very high specifications. And what that means is you can actually expand the lifespan of that particular old laptop. And what this means is that it reduces emissions by about 30%, right? So either by lifespan extension or by recycling, we can do our part to reduce our physical carbon emissions for the digital world. In this case, we're talking about the hardware involved. And the other thing that we want to talk about really is we want to go back to the very beginning of low carbon computer coding, right? For all of us here who haven't quite, who have a bit of a fuzzy memory, low carbon computer coding is essentially computer code that is incredibly energy efficient And therefore, when we look at the carbon footprint, it's incredibly green in terms of its carbon emission. So when we think of that, what happens is that one of the first things we want to do, especially if you're in the IT department, is to reduce server energy. So servers are these rectangular blocks, right? That look exactly like an old personal computer, an old PC. If you got an old desktop computer, you've got your screen and that block. Right? A server looks incredibly similar to that, just that it's much slimmer. And what we want to do really when we think of low carbon computer coding is how can we get these servers to consume less energy when they work for us, right? So caching is a technique that is open source. So basically it's readily available in the internet. And if you're in the IT space, you'd probably be familiar with this as well. For our non-technical friends, caching basically means to store data in a memory space. So what that basically means is that instead of your computer having to retrieve the information every time you click on the button, it actually stores it very close to heart so that it doesn't need to go back to the depths of your computer to pull out information because it's already there right beside where the information needs to be, right? So this is what it is caching. Caching is basically a creation of a temporary memory that allows your computer to not have to dig very deep to continuously retrieve information. Second thing here, and I use this sign, this is a summation sign to represent this. This represents lightweight algorithms, right? So having very low complexity algorithms actually allow for lower energy consumption, meaning that if the algorithm is easier to compute, the amount of energy consumed is naturally lower, right? This actually is very efficient, especially when we think of computers that are used for internal tasks, right? So sometimes for credit unions and the like, there may be a need to assess risk, right? In terms of who you're lending credit to. So that is what we call as client-facing algorithms, because those algorithms will be used by your credit union vis-a-vis your client, right? To assess perhaps credit worthiness, the ability to pay back loans, and the like, credit risk, right? So those are what we call client-facing algorithms. Lightweight algorithms are usually internal algorithms. For example, they may power internal systems, right? Things in your credit intranet and the like. So these algorithms generally don't have to be very complicated to do the same task. And that's really where we can have that angle to implement lightweight algorithms. So both of these are able to dramatically reduce energy consumption. Caching in some instances can cut energy and carbon by 50% and therefore contribute to overall sustainability efforts. Okay, so another concept that we want to talk about today really is called serverless computing. So in the previous slide, I talked about a server, right? It's that rectangular block that looks exactly like your personal desktop computer. And so when we talk about serverless, computers, let me just pop back up. I just received a message that my screen cannot be seen. Can I confirm that my screen can be seen now? If everyone can see my screen, can you just give me a thumbs up sign? Can everyone see my screen? Thumbs up? Okay, perfect, perfect. All right, so thank you, Katie, for letting me know that my screen wasn't visible just now. But essentially, for this slide, we're going to talk about serverless computing. And we talked just now about servers, right? So there are those rectangular blocks that you see. If you own an old PC like me, you see your screen and you see the desktop, basically computer portion. Below servers, a very thin version of that. There's actually a new emerging trend worldwide to use what we call serverless computing, right? And essentially, it does something really incredible because it can reduce energy consumption by about 70% compared to server-based architectures, right? So you'll probably be wondering, oh my gosh, what is this miracle that we have found, right? What is this serverless computing? How do you remove that rectangular piece of metal that you see, the server, and how do you bring it to a serverless condition? Well, actually, the term serverless computing is a slight misnomer because you actually still have a server per se, right? The only difference is this. In traditional settings, your office, your credit union would have a physical server, right? In a server room. So it's a small room. Sometimes it's fairly big, right? Depending on how large the credit union is. And they have tons of servers inside, right? So when we talk about a serverless computing, we're actually saying that we get rid of that room, we get rid of those servers, and instead we send the data that was supposed to be processed in those server rooms into the cloud. So you technically don't have a server in your room, so it becomes serverless. So one of the examples right here is AWS, which is Amazon Web Services. I don't own any shares in them, so disclaimer there. Basically, what happens is that when you load things into the cloud, as compared to a server room filled with servers, what happens is that they actually can consolidate all of the users. What does that mean? It means that in a typical server room, you might have, say, one server, and perhaps on that day itself, you're just using 50% of that server. So 50% is used, while else the remaining 50% is actually wasted. So what happens in a serverless computing paradigm is that if you've got 50% and say another credit union, say in Singapore, where I'm based, has 50%, and we both send it to Amazon, so the Amazon server will now be used 100% full as compared to having being used 50% full during that period of time, which basically means you eliminate idle server wastage and you eliminate idle energy consumption. So that's basically something that's very interesting. And yes, thank you, Alicia, for the comment. It really is a very interesting concept, and it's something that really can dramatically reduce both energy consumption and, of course, the carbon footprint. So on the right-hand side, you see this called automatic scaling for variable traffic. It sounds very complicated, but it really just means that if you use more, for example, if you use, say, 3 servers worth of energy and computation today, you don't have to buy 3 physical servers. In the past, say in about the 2010s, the early 2010s, especially when credit unions had physical server rooms, if you anticipated that you needed like 10 servers worth of traffic for a certain day of the year, perhaps during payday or during loan repayment day, where there's a spike in traffic because everyone just needs to use the system to make payments, to make transactions, then you might actually overcompensate. So you have 10 servers that you purchase for your server room simply because the maximum load you will get is 10 servers worth of load, right? But the problem with that model is that you may only get 10 servers worth of usage for a single day every month, which means for the other 9 days, right? Or rather for the other 30 days, you're just using 5 servers or 7 servers, meaning that you have idle servers, and that would basically mean energy wastage and carbon and increase in carbon emissions. So these are some of the things that you can critically consider as well. Serverless computing increasingly is popular as part of a hybrid model, whereby mission critical and very core infrastructure is kept within the credit union still. Those are things that you need to keep either for data privacy reasons or simply because they are extremely sensitive core architecture, basically systems that cannot be given to anyone else and must be taken care of by the credit union, those are still put in physical servers in the credit union itself, whereas everything on the periphery, everything that isn't that important or can be outsourced in that sense, is sent to a serverless computing realm. So that's really one of the other things that we want to talk about. My apologies, I'm not sure why the screen has bounced out again. Okay, now let's go to the next slide, right? Slide number 5. So the next thing really is called energy optimization through virtualization. Okay, and so we've got a couple of key terms here. So energy optimization is basically means reducing the amount of energy being consumed to really match the work rate, right? Essentially the reduction of energy waste, right? So virtualization is basically when you use what you call you do what you call server virtualizations, right? So you have a virtual machine on a single physical server. You're probably thinking like, if you're not technical, you're probably thinking like, oh my gosh, like what is this, right? So let me break it down for you bit by bit. So if you have a single physical server, right, you've got this single rectangular server, what happens is that traditionally, one server would run one thing, okay? So imagine if you have your desktop in front of you or your laptop in front of you, and you go to your home page, right, your desktop page, right? It does that one thing, right? It serves you, and it's your desktop. You can go and open and close those folders and the like. What happens in a physical server with multiple virtual machines, it means that, for example, if you take your laptop as an example, then your laptop now will have your desktop whereby you can use. And when your colleague comes over and uses your laptop and logs into his or her account, it will have then his or her information being pulled up and used there. So very simply, virtualization and the use of virtual machines means that you can fit multiple people's accounts into a singular server. And what that ensures is that when, for example, you're not using the server, someone else from your team can use their virtual machines and run it on that server, right? So very similarly to using cloudless or rather serverless computing that we saw in the previous slide, virtualization helps to reduce energy consumption, and this time really even up to 80%, right? Because now instead of having multiple servers, you're just using one, and you're just keeping whatever you had in other servers into this server, just as in different accounts. Yeah. And so what happens is that a virtual server in the theoretical sense can actually replace up to 10 physical servers. Of course, I would caveat that. It depends on what the server is actually running, but it can actually 10x your energy efficiency. Yeah. So these are things that you can take note of. And on the next slide, as you can see, it's green hosting. So green hosting is an increasingly popular concept, especially in Europe right now. And it's really the concept of understanding who actually is hosting you, and more importantly, what type of energy they run. All right. So this is very really highly correlated to websites. So if you have a website, there may be different host service providers. Examples include, for example, GoDaddy, right? Where you can go to godaddy.com to buy a website domain name. So you can buy www. For example, greenhosting.com, right? And when you buy that domain name, they usually come with a package to tell you that you cannot just buy the name, but they can host it for you, meaning that you have not just that address in the internet, but you have that so-called virtual home on the internet, so that when I Google www.greenhosting.com, I can actually find you on Google. So increasingly, we have hosts like, for example, green geeks, right? That you can see in the middle right here that essentially use green energy. Yeah. So what happens is that increasingly so these hosting providers, they either use solar, wind, or hydroelectric power. This can either be found on their website itself when they tell you that, okay, by purchasing this plan, your website is run on green energy. Or sometimes they may not say that very explicitly, but if you look at their ESG reports, you can actually see that all of their hosting services are run by renewable sources of power. So this is one, right? So green gigs, I mentioned just now, what happens is that they don't just do green energy, they even offset the energy used to power their servers and infrastructure, 300% of it. So what that means is that they are, in that sense, carbon negative, because they not only offset whatever is used to run their website and your website, they actually offset even more, in this sense, like 2 times more, 200% of the energy consumed, right? And so what this means is that when you use a green hosting provider, you can essentially have that immediate sustainability benefit. Essentially, you can even put it out on your website that this website is run on green energy. So whoever who is using this website isn't technically contributing to more digital carbon emissions. So it's a very nice, quick green win. So the next tool that we want to talk about, and we're going to go into emerging trends right now. At any point in time, everyone, if you cannot see my slide, if it freezes up again, please let me know. But other than that, right, I'm going to continue now and talk about AI energy management. So AI, when we talk about AI energy management in particular, it serves a couple of purposes, okay? The first thing that it serves really is the talk about how AI energy management can help your server rooms. So if your credit union still has, for example, a server room, a physical room where you have your own servers running to power your financial transactions and your basically digital infrastructure, what happens is that an AI-powered energy management system can actually alternate cooling, right? That's one of the things it does, so that on a very cold day, it actually will reduce the air conditioning so that you don't need to have so much air conditioning for your servers. Servers are actually very, very power hungry, not just because they consume a lot of power at the CPU and GPU level, but because they need to be kept at a very cold temperature for them to not overheat, right? So if a server overheats, there is a high chance that it might A, damage the chip inside, or B, the server itself might actually face an outage, right? So essentially what happens is that it will stop moving, just like the hand icon that somehow has appeared on top of me, which is lower the hand. And it will just stop working because it's just too hot, right? It shuts down literally. So having an AI-powered management system can help you to really cut those energy costs for cooling, especially if it's a cold day and there isn't that much need for air conditioning. So the other things really would be it being automated and load balancing. So I haven't really talked that much of load balancing, and it's a core concept that I just want to share a bit more right now. So load balancing essentially is the act of actively allocating available resources to immediate demand. So what that means is that if you need to use more server resources, the AI will find the nearest available supply, in this case, the nearest available server, and allow your load, your particular demand to be satisfied, right? So this active load balancing is very important because in the past, without artificial intelligence, you would either need to hire a personnel to actively monitor the load, or you can preset what you estimate to be the loads. And what happens is that if there is an exceeding of the load limit, your system will actually may potentially slow down. So these are things to take note of. Okay, so another thing on the emerging side of things, the blockchain. The last time round, I think there were some questions on this, and it's actually very interesting because the blockchain, as we shared the last time, massive polluter of carbon emissions, but there is also some, I would say, a silver lining to it, right? And one of the things with blockchain is a concept called immutability. So it's spelled immutability, immutability. Essentially, it means that it can be changed, right? Once you do something to the blockchain, it changes, and the change is to a great extent forever, right? So what that plays, or how that plays into us, the environmental space, is that blockchains can actually be used to track carbon credits in a fairly transparent manner. It's not 100%, but it's pretty transparent. So what that basically means is that if you buy a carbon credit, it is on the blockchain, and you use the carbon credit to offset a particular carbon emission that you have, chances are that it is very difficult for a third party, or for anyone else for that matter, to use that carbon credit again. So in the carbon credit space, and this is also educational knowledge, even though it doesn't really relate directly to digital sustainability, is that there is a lot of double dipping in the carbon credit space. So one of the major problems that people face in the carbon credit market worldwide is when they use a carbon credit, in more technical terms, it's called retirement of a carbon credit. What happens is that it's meant to be just kept aside, right? You use the carbon credit to offset some emissions you have. It should not be used again. In some instances, unfortunately, these carbon credits are used again, and sometimes again, right? So the blockchain is, to some extent, a good solution for that because of its immutability principle, which basically means that the carbon credit, once it is used, will be reflected as a used carbon credit on the blockchain, and therefore no one else can technically use it again, right? So a fun fact here, 10% of banks adopt blockchain for ESG reporting. They do that for a variety of reasons. Some banks use blockchain very experimentally. Some banks might be a bit more, I'd say, advanced in this. On the credit union space, I think blockchain adoption is still considered an emerging trend, and we're likely to see potential POCs in this space in the years moving forward. Okay, so another trend, and I'm not on to the next slide, that we've seen is called edge computing, right? So you must be thinking, oh my gosh, today's talk is like really, really technical. I'll give you guys time to digest all of it in a moment's time. We're ending this as this really first part of the theoretical knowledge real soon, so please bear with me. But another thing that I want to really share with you today that's very close to my heart is called edge computing, right? So you've heard of serverless computing, you've heard of low carbon computer coding, and now we've got something else, edge computing, and you're thinking like, what on earth, right? Like mind blown. So for those who may not really be very familiar with the concept, edge computing means that the processing is done at your device itself. Let me give you an example, right? So in the newest Apple-related artificial intelligence that will be used, I believe it's called Apple Intelligence. What happens is that they will be using Google Gemini, if I'm not wrong, to power Apple Intelligence. And one of the key demands for Apple Intelligence on your iPhone, or at least your future iPhones, would be that edge computing is used. So you're thinking like, wow, like I didn't know Apple Intelligence is related to edge computing, and I didn't know that my newer iPhone, the next iPhone I get potentially, will have edge computing. So essentially, what happens when we talk about using ChatGPT, Google Gemini, things like that, is that when we use these services, when you ask, for example, ChatGPT, how do I cook chicken noodle soup, right? They will send that question to the cloud. ChatGPT answers that in the cloud, and they send you back the answer. Edge computing is very different. So edge computing brings, for example, ChatGPT onto your computer itself. So when you ask ChatGPT, how do I make chicken noodle soup? He actually is on your device and he answers you, how do you make chicken noodle soup on your device itself? So the implications of that is that data isn't sent to the cloud to and fro. And what that means is a couple of things. The first thing is that it is safer because your data isn't transferred out of your device, right? No one else except you will know that you're trying to make chicken noodle soup, all right? Secret safe. The second thing really is in terms of speed, right? Because sometimes the cloud gets overwhelmed and your request, the question you send to ChatGPT, for example, is stuck in the cloud, right? And that's why sometimes when you ask ChatGPT a question, he takes a bit longer to respond. It may or may not have to do with the complexity of your question. Sometimes you may ask ChatGPT the same question, and sometimes the answer just takes longer, right? That's because the cloud is overwhelmed, right? And another thing is also, and this also ties in to speed as well, is that if you're in a place with slightly worse off internet connection, right? Your bandwidth is a bit limited, internet infrastructure is generally a bit more basic. Then what happens is that the speed that it takes, right? The time it takes to send your request to the cloud and then back, that's going to be longer as well. So edge computing brings all of this computation, in particular in the AI world, onto your device, onto your chip, and it processes data locally, right? Which means that less energy is spent sending stuff, less energy is spent taking back stuff. So in other words, because everything's done locally, you don't have to get so much energy being used. So it reduces network energy costs. That's the word I was looking for just now. Basically, the amount of energy you take to send information and to receive information, that's called network energy cost. And what happens really is that theoretically speaking, you can save up to 20% of energy. Another good use case for edge computing actually would be your IoT sensors. So if you've got an IoT sensor somewhere around maybe your home or your company, measuring air quality or measuring temperature or measuring something else, right? So all of these IoT sensors, the good portion of them, I would say, actually use edge computing, a very basic form of edge computing, because they need to process, for example, the air quality, right? Right there on their chip. It cannot be perpetually connected to the internet. The air purifier or your small thermoset sensor isn't perpetually connected to the internet. In fact, most of them aren't connected to the internet. As such, all of the processing has to be done on a chip itself, and that's a great example of edge computing as well. So this is relevant to credit unions because moving forward, there might be several, I guess, choices that you need to make between cloud usage and on-premise usage. Like I mentioned just now, hybrid models are getting very popular. And when we think of a hybrid model, it's not really a 50-50 split, right? A lot of times it could be a 70-30 split, an 80-20 split, and it really depends on the type of data you're processing. And of course, what your tolerance limits are in terms of, for example, speed of transaction and the like, right? So edge computing is something definitely to consider as a trend moving forward for credit unions. Okay, so when we talk about applications, right, and I really wanted today's session to be very much in terms of not just general big picture things, but how you can bring it back tomorrow, how you can use it the first thing you're back in the office tomorrow, right? So the first thing that we think of would be e-statements. So there's a huge shift from paper statements to digital statements. And really the challenge statement is that when we reduce paper usage, we're actually also increasing digital emissions. So what can we do? How can we basically manage that? Well, the first one really is green hosting providers. So that's very important, especially if your e-statements are accessed via your websites. So there are many ways to handle e-statements. Some companies simply just email the e-statements to their clients, their customers. Others actually don't use the email route. They require the client to log on to their website, right? And when they log on to their website, they require the client to therefore download the e-statement from the website. So if your credit union is the one that uses a website route, whereby your client, your customer will have to go online to your website to download the e-statement at the end of every month, then it's a good idea perhaps to use green hosting providers to kind of offset the digital carbon emissions that you see. So that's one. And also, really, it's about the frequency of e-statements, something that I briefly touched on in the previous session as well. One of the things is that I would say some financial institutions do provide daily. I've even seen some that provide half daily updates with regards to a client's remaining balance, their remaining loan details, things like that. And while that's very good in the sense that it's a very timely, almost real-time monitoring, since you're giving 1 to 2 updates per day, if your credit union is currently doing that, you may wish to reconsider the amount of frequency, especially for non-critical pieces of information. For example, if a credit loan isn't due anytime soon, sending an email of the amount to be due, amount owed to a particular customer very frequently, both will frustrate the customer and was also bad for the environment. Okay, so the other thing that we want to talk about briefly as well is online banking. So that's another area of application. So the first was e-statements, second was online banking. So I understand that some credit unions may have online banking facilities, loan applications, loan repayments, and the like. So using an efficient platform, in this case, using serverless computing, using part of the cloud, and also using low carbon computer coding, incredibly good ways to reduce your carbon footprint there. It can also allow you to speed up your particular servers, or rather speed up the particular experience by your customers. So when they go to your site, it's actually a bit faster if your particular infrastructure is decarbonized. And so this actually is the end of session 2. Before we continue, today we have a very, very small, I'd say a very intimate session. So I just wanted to ask if everyone is still with me, or if things are too technical, have things gone through the roof, right? Everyone here still with me?
Still with you, Ian.
Fantastic. Thank you, Alicia. Thank you for the thumbs up, Hazel, Katie, and Cassie. I hope the first session wasn't too much of an overkill. I tried to really water it down best I can and made it relevant to everyone. And what we want to do right now is we're just gonna take a quick 5 minutes break, just for everyone to freshen up, digest what you've just heard from me. If you've got any questions, feel free to type it into the chat box. We'll be back at about 7:50 a.m. Singapore time, which should be CT time in about 5 minutes. Yeah. So let's be back here in 5 minutes. We go to the washroom, freshen up. We're going to go even deeper for more hardcore stuff before we change the mic over to everyone else, right? And as Cassie mentioned, you, the audience, will be the facilitators for the in-depth session on your particular companies coming up real soon, right? So thank you so much for the timer, Cassie, and I'll see you guys back in about 5 minutes. Thank you. All right, I hope all of you've got a good 5-minute break. And before we continue today's session, can I just confirm? I see you. Hi, Alicia. Nice to see you. Hi, Hazel. Wonderful to see you too. Hi, Donnie. I've not seen you yet, but I'm sure we'll see you pretty soon. Was wondering if anyone here has any questions for the first part of today's session. the deep dive of theory. If anyone has, feel free to unmute yourself. All right. Or if at any point in time later during the session, you've got questions, just feel free to put it onto the chat box, right? So what we're gonna do now is I'm just gonna go back to a segment that I had unfortunately skipped just now. And this is also gonna be a good recap for all of us before we turn the mics to yourselves and we start looking at each of your particular credit unions. So I guess the rationale for today's session, just want to emphasize, is why digital sustainability matters now. So the first part of today's session was really on some of the things we can use technology for, how we can harness technology for good for our credit unions, right? But we also need to understand and that technology has its limitations. And that's the reason why digital sustainability matters more than ever, right? So in terms of ESG prioritization, the numbers are clear, right? 74% of financial institutions prioritize this because of regulatory pressure, and of course, because of internal pressure. And digital carbon emissions is something that's about 4% of global emissions, on the way to about 14% of global emissions. So it's a huge, huge problem. And green practices, and this is a fun fact for all of us here, is that it can actually boost member retention by 20%, right? There are various reasons why, one of which also includes the fact that companies that have green practices generally are seen as more mission-driven and therefore are more likely to retain your current working populace. Okay, so these are some things that you're actually going through now. So today's session is 2.5 hours. We just had our 5-minute break. I actually brought it forward just in case any one of you are too tired. We can have one more after the sharing session later if time permits. And what we want to do is make this an interactive session, right? So if you've got anything, feel free to just pop your questions, comments, your emojis, anything, right? We really want to ensure that this session is one that is not just a lecture when I drone on and on and on. It's going to be a time of fun learning. All right. So just want to circle back to learning objectives before we continue with the next part of today's session. I really want everyone here to gain advanced knowledge and tools for digital sustainability. And that's the reason why we've had our deep dive earlier just now, right? The reason here, the reason why I'm here, the reason why all of us are here is to ensure that we don't just have an inkling of the digital sustainability issue, but we've got the knowledge and we've got the plans, right? Basic as they may, to really make a change when we go back to the office tomorrow. So in a moment's time, we're going to go to this part, the second part already. And the second part is on measuring and reducing your digital carbon footprint. And the last part we're going to talk about today, actionable strategies. Yeah. So what are things that we can do? What are some strategies we can put in place for tomorrow? Okay, so I've introduced the introduction objectives. We've done our deep dive. Right now, we're going to go into our first of 2 interactive segments, and that's really on carbon footprint counting. And then we're going to talk about sustainability road mapping, and that's very, very important because this one is for digital sustainability. Yeah, so it's going to be a bit different from other types of roadmaps that you may have seen. Case study, whereby we're going to really ask each member here to talk a bit of your credit union and how potentially you hope to make changes to them, the strengths and the weaknesses in the days to come, right? And last but not least, we'll have a roundup of the action plans and closing. So what we hope to have really is a bit of engagement. I see all of you are really engaged group of students and participants, and I'm really glad to be here. Let's keep up the momentum and let's continue to ask questions. Raise your hands if you want to have a comment on the microphone. And why it matters really is something that we all know, but just to reinforce that memory, right, works better. You learn more whenever you're actively participating. It's 75% to 5%, right? And that's not by me. That's actually by the National Training Laboratories 2003 paper. Yeah, so actively engage, and I'm sure through today's session, you're going to find it really meaningful, right? So we've had our deep dive just now, where I went on key topics, right? Emerging technologies, serverless architectures, talking about edge computing, talking about how we can have green computer hosting. So what we're going to do in a moment's time is calculate our carbon footprint, right? It's not going to be the most accurate because of the nature of today's session. It's a virtual session. All of us are spread out around the world, and there are many key data points. But what we hope to go through in our carbon footprint session is the methodology, right? So how do you do it so that when you go back to the office tomorrow, you can at least have an estimation of your credit union's carbon footprint for the digital world, right? We're then also gonna talk a bit of data center optimization if time permits. And before I continue, there's one thing I want to talk about. It's called Scope 1, Scope 2, and Scope 3. So if you've been in ESG space, you might have heard these terms bounced around. Even if you're not from the ESG space, you might have heard this being talked about in the media before, right? So what is Scope 1, Scope 2, and Scope 3? These are actually three, I'd say, things that you can measure when we talk about carbon footprint. Scope 3 is essentially the carbon emission of your client, right? Or rather, sorry, of your supplier, your vendors, right? So if you've got people in the downstream and upstream, the people in your who are providing you products and services, those would be your vendors. They would be part of Scope 3. Scope 3 emissions. Scope 2 emissions are generally the electricity that you use in your building and in your company's premises. And Scope 1 would be like the direct carbon emissions from your activities. For example, the carbon emissions of some of a product that you produce, right? So that would be your Scope 1 emission. So Scope 1, Scope 2, Scope 3. We won't go too deep into this, so don't have to be too worried on the technicalities, but just need to know that when we talk about digital carbon emissions, it's generally Scope 2 and Scope 3 because it has to do with number one, your electricity consumption of your servers, and number two, the electricity consumption of the cloud solution providers that are providing you the serverless architecture if you have moved onto the cloud. Yeah, so Scope 2 and Scope 3 will be the main focus for digital carbon emissions. So renewable energy, once again, of course, it's something good if you're looking at decarbonization. And of course, when you think of choosing your particular service providers for cloud, always prioritize, I'd say, cloud service providers that have that are using renewable sources of power. And there's actually another term that we want to add here. It's called additionality. That's a very important term, additionality. So essentially, when these cloud service providers, these data center operators that you may be using, do they actually put out more solar panels? Do they actually put out more windmills? Or are they using existing renewable sources of power? Because if they are actually putting out extra solar panels, extra windmills, and the like, there is additionality, meaning that it's better for the earth. There is more solar power. But if they are just buying existing solar power, wind power, hydropower, then they're actually not doing any additional good for the world, right? So this is a core concept that you need to bear in mind, especially when you're thinking of renewable energy. Is there additionality or is that not in additionality? So because if there is no additionality, it's more of a feel good for us because we feel good that our servers are run by renewable sources of power, but it actually doesn't do the planet any good because even if we didn't use that service provider and they didn't use that particular solar panel, it would already have been there providing solar power for someone else, right? So there, in that case, there is no additionality. So always be very mindful of the concept of additionality when you think of renewable energy. Okay, so wrapping up this very quick housekeeping bit for us today, Today, we really hope that you can have a very comprehensive understanding of digital sustainability, and more importantly, how you can bring knowledge on the tools back home with you and back to the office when you head back tomorrow. So I'm going to stop sharing this particular slide deck, and we're going to go on to slide deck 3. Okay, so this part here, let's begin. Okay, so once again, if all of you can see my slide, please give me a thumbs up. Thank you, Alicia. That's wonderful. Everyone else, can you see? Thank you, Katie. Thank you, Cassie. And thank you, Hazel. That's fantastic. Thank you, Donnie, as well. All of you have been participating really, really actively, and I'm very, very grateful for that. Okay, so what we're going to do now is we're going to head on to full screen once again. If at any point the slide freezes, sometimes it happens, let me know. Just put it on the chat box. I'll fix it ASAP. All right, so sustainability roadmap for credit unions. What we want to do is we want to talk about assessment tools right now. So the good stuff, right? What are the things that you can do? So an introduction really is the first thing I want to talk about. And these are some tools. Feel free to take a screenshot or to write it down. Carbon Trust is an international organization, and they have a calculator, right? So the Carbon Trust essentially has a pretty, I would say, plug-and-play user-friendly tool that can quantify carbon footprint. So feel free to use that. I'm not sure if it's free of charge, but you can have a look and you can let me know, all right? So the next one really is called GreenieWeb software. So it's basically a tracker to manage sustainability metrics as well, something you can use. Once again, caveat, whether it's Apple or Carbon Trust or GreenieWeb software, I have no financial interest in them. I do have financial interest in GreenieWeb, so if you use that, then that's another story. Okay, so internal audits, basically your third-party service providers, your large consultancy companies, they can also help you to manually gather critical data points, right? So 3 things that you can consider: Carbon Trust, GreenieWeb software, internal audits. So these will give you essentially an idea of your digital carbon footprint and some amount of insights, right, to drive sustainability initiatives. Okay, so this part is very important, right? If you're using your phone or your laptop or something, please screenshot this or write it down on a piece of pen and paper. Because this slide here is very important because it's the basis of digital carbon emissions for your company, for your credit union. Yeah, if you have this information, you can start your digital sustainability journey, and then we can go deeper and deeper and deeper from there. But these data points are absolutely necessary. So the first thing you need to know is how many servers do you have? Anyone here knows how many servers your credit union actually uses right now? Please raise your hand. If you actually know, and if that's correct, then you are in the right place. Good job, Alicia. So this is incredibly critical to know what is the carbon footprint from an energy perspective. Yeah, server count, both in terms of servers that are on premise and servers that you're using on the cloud, right? When we talk about serverless architecture, that's very important. And servers utilization rates are also very important. Utilization rate of a server basically means how busy is your server, right? If it's 50% utilized, has a 50% utilization rate, that basically means it's busy 50% of the time, right? And the other 50% of time, it's still consuming energy, but it's not doing anything meaningful for you and for your client and for the planet, right? So these 2 things, very important. If you're using a cloud service provider, try to get the information from them. Usually they should be able to give you an idea of server count because you would potentially have bought a certain number of servers. There are different types of partnerships with cloud service providers, one of which is where you buy either a data package or an energy package. For those types of packages, it's going to be a bit harder to know the number of servers simply because they don't have to technically disclose it to you. An energy package is whereby you buy, for example, 500 kilowatt hour worth of server power per month. This is a pure hypothetical, right? And what that basically means is whether they have 100 servers using 500 kilowatt hour or 5 servers, that's up to them. It's more convenient for the cloud service provider because they can balance between old servers, new servers, and different types of servers. But it may not be as good for us at the credit union side because it becomes more obscure. We don't know what servers they're using. And so it's harder for us to count the energy consumed and more importantly, the carbon footprint, right? Because when you buy an energy package from your cloud service provider, that's the maximum amount of energy they will provide you, but they don't really tell you, or they aren't obliged to tell you how much energy they are providing for your servers at a singular point in time. And that also means that utilization rate becomes a bit harder to track as a result. The second thing really is device usage. So servers is just half the story, yeah? Every time we ask ChatGPT a question, we send a question from our laptop to the server and then back to our laptop, which means that half the story is still our laptop, yeah? So measuring the employees' laptops and mobile devices, this is easier in a back to work setting, meaning that if you've got a physical office and if most of your employees are in the office most of the time, it's much easier to track because you simply track the company's laptops and the company's mobile devices. But from a work from home setting, things get a bit trickier because most employees don't use the same setup as at home as they do in the office, right? They may be using their personal laptops or their personal mobile devices. And what that basically means is you're going to have a different calculation in terms of energy consumed, a different amount of data being processed, and the like, right? If they're using a really old computer at home to do company work, that basically means that your energy consumption will go up, your carbon footprint will go up as well. So these two, very critical. If the easiest case scenario is for your credit union to have servers in the office itself with employees there 100% of the time, but in the current work setting, that's almost impossible. So do your best to count whatever you have, whatever else that's missing. You can always check in with your employees what model of computer they're using, and for your cloud service providers, you can try to push them to give a bit more information on that sense. Okay, so kilowatt hour consumption from your data centers or hosting providers, check the energy usage. Sometimes, for example, we talked about different website hosting providers. So ask them what is the energy usage. They should theoretically have that information. Also track the ratio of paper versus digital statements. If you have the opportunity to track how many e-statements are being downloaded from your website, that's a good start. If you send e-statements via email, then that's even easier to count. How many emails are you sending? What is the frequency like? And for emails, it's even better if you can find out what is the open rate of your email. So if the e-statements are downloaded directly from your website, you are 100% certain the person wants to read the e-statement, has downloaded it, and will kind of do something with it, right? Emails are a bit trickier because sometimes when you send an email, the recipient, the client customer may not open the email. And if they don't open the email, that basically means that there is wastage, right? There is data that is spent, energy that is consumed, but wastage in terms of digital carbon emissions. Life cycle, once again, this is far easier if you have your own servers and your own company devices. Monitor their life cycle. It's good practice, right, to have just an Excel sheet in your company that states the life cycle of every electronic device. It doesn't only include servers and laptops. It could include your credit union's air purifier, for example, the air conditioners, everything, because all of this will eventually become electronic waste, right? So not just servers and mobile phones become electronic waste. Your air conditioners, your printers, all of them, right? will also, and fax machines, if you still use, will become electronic waste. So it's good to keep track on their lifespan. And one incredibly good practice is to always keep them because the better they are well maintained, the longer they live. So as to speak, they live the longer their usable lifespan, and therefore the lower the amount of e-waste you produce, right? Because you don't throw them into the bin that often because they don't spoil that quickly. Okay, so interactive workshop time now, right? And it's meant to be a group brief and debrief. But I first wanted to check with everyone, right? And perhaps we can start with Alicia. So based on these server accounts, device, and the like, right? So where is your credit union at? And what are some things you think can be improved at present? What is one thing you can bring back to the office tomorrow to say, hey, we don't have that data point, let's find it out. Or B, there's something that we can try doing for.
The thing that I think we're already doing quite well is we just recently switched to a cloud-based software platform for our banking, and then we have gotten rid of all of our servers in our server room. So when you were talking about the serverless thing, I was like, oh, that's us. We went to the cloud. So that's one thing that we've already implemented. I think we're doing quite well in a bit of this, but I'd be really interested to track down like I'd like to look into the e-statements, but we recently had that conversion, and a lot of our statements are in limbo. So it's probably not a good time to really like try to. We're going to look really good because a lot of people can't get their statements, unfortunately, online. So that's something I'd be interested to do, like maybe Q3. But one thing I think I'd really like to implement tomorrow when I get back to the office is the device usage and your suggestion to track them. We're looking at like doing our sustainability reporting and like really leaning into that and trying to help our small businesses with their sustainability reporting. So I think that's like a really great starting point and something we can implement and see if we can improve upon it. And maybe I'll stop asking for a new iPhone every 2 years and I'll try to hang on a little longer.
Or you could ask for the latest one this time, and then you
Oh,
hang on
that's
for that for 2
right.
more years.
He only got me the 15. I should have been like, it would have been more sustainable to get me the 16. Thank you. I like that, Ian. This has been really great so far. Thank you so much.
Thank you, Alicia. And that's really wonderful work that you're doing. Very glad to hear that the serverless shift has happened in your particular instances as well, and how device usage, which is incredibly important, something to definitely look at for small businesses, right? Because they wouldn't really have much knowledge on their server accounts anyway. It's far easier to ask them what brand of laptop they're using and count the carbon after that.
Right. Great. Thank you.
Thank you. And Hazel or Donnie, would you like to share as well in terms of where you think you're at and how things can change tomorrow? Hazel first. I see Hazel. You're there. Hazel, you're on mute. Hazel, you're on mute. You might need to unmute yourself, Hazel.
Sorry. I was just saying,
Yes.
Alicia, I really appreciate your comments. We're very similar in a situation. We've had integrations and we have, e-statements and things to figure out and are trying to get rid of our paperless. And there's a lot here that I'm really things that I haven't thought about before or realized the imprints that we're making and the device usage. I wouldn't have thought of that. And working at home, how much more energy we're using. So I'm just finding this very valuable.
Yeah. And one of the things when we talk about work from home, right, employees as well, is that if we want to go to the granular level, I guess laptops and mobile phones first line of basically calculations. But for Hazel, Alicia, Johnny, of course, Katie and Cassie as well, one of the things that we can start thinking of would be the entire suite of devices. Because I see, Alicia, you're wearing a headphone that also consumes energy if it's a Bluetooth-based device. So it really depends on, oh, it's wired. Oh, that's fantastic. So one of the things that we really want to think of when we do work from home is what we call the twinning methodology, right? So what do we have in the office that we might potentially use at home as well? So that's called the twinning methodology. So if I'm using a printer in the office, I would potentially use that at home as well. And if I use that at home as well, I need to count its electricity consumption and its carbon as well, right? So if, for example, I'm using another device in the office, for example, if I use a screen and a desktop, right? A desktop setup, right? So two things that I need to measure as compared to a laptop. So these are things that I need to ensure mirrored 100% in the work from home setup. One of the things that we realized that have led to discrepancies when folks measure office carbon and energy versus home carbon and energy is they don't do the twinning method. So they kind of lose things along the way, and they think that, hey, it's very green to work at home, so everyone should stay at home. I love work from home, by the way. I'm a big fan of it, but accuracy still does matter. And if twinning is not done comprehensively, we kind of like lose sight of the accuracy needed for that data, right? So great work, Hazel, as well. And Donnie, where are you? Donnie, would love to hear from you. Where are you and your credit union at in terms of all of this?
Can you hear me properly? Sorry.
Yes, I can hear you, Donnie. How are you?
I'm doing good, thanks. So, to be honest, we haven't really been thinking much along those lines, except recently. But we have some things in place that would have been maybe just to increase internal efficiency in the past. For example, we do have electronic statements. We do have online banking. We have virtualization of servers. We have about maybe like 15 virtual servers, only about 4 or 5 actual physical servers. And the intention is to eventually migrate some resources permanently to the cloud. We do use Office 365 to all our mail and all of our office stuff, document. Well, not all documents yet, but mostly mails, and we use SharePoint and OneDrive and things like that. So that part, so we can hybrid in some respects, but the eventual goal is to really maximize the benefits of the cloud and maintain a sort of a hybrid where we can take advantage of both the benefits and the benefits of being on premise and the benefits of being in the cloud at the same time. What I think would be really good and something we could do in the short term is really monitor and track the use of devices, because we have officers they have a laptop, a phone, an extra monitor. So it would be really interesting to track the consumption of these devices.
Thank you so much, Donnie. And I think you hit the nail on the head. All these extra devices, what we call auxiliary devices, generally consume a lot of energy, but because they're not the main one, we seldom quite put them into perspective. So congratulations as well. Not sure if all of you've heard. So in Donnie's side, they have up to 15 virtual machines as well. So using virtualization very well, congratulations to you and your team. And with keeping the, of course, physical servers, so using a hybrid modality, that's fantastic as well. So as earlier mentioned, I think what Donnie does will be the future of what most credit unions and financial institutions will do, whereby there will be a migration towards the cloud, but at times it will not be a full migration to the cloud, right? Depending on what bits of information you are processing, and of course the jurisdictions you're in. Please bear in mind, even though there are many benefits of going to the cloud, many jurisdictions still maintain that we as credit unions, we as financial players need to have some bits of information on premise. The short form is called on-prem. And what that basically means is that those information cannot and should not be migrated to the cloud. So thank you once again, Donnie, for that sharing. Might there be anything else you'd like to share, Donnie?
No, I'm good for now. Thanks.
Okay, thank you so much, Tony. And so what we're gonna do is this debrief, right? We've had a quick sharing session. If we had more people, it will be more interesting because we will have a lot of back and forth. But today's session, just perfect, right? Having three prime examples, Alicia, Donnie, and Hazel, and what you're doing at your credit unions. So in terms of this first bit on carbon counting, one of the things I want you to start feeling comfortable with, all right? Start feeling comfortable with is the idea of data gaps, right? So a lot of times you may realize that, hey, I don't have this bit of data. That's actually fine, okay? And the idea really is that when we go through this phase of calculating carbon, more often than not, you'll find that you do not have data on certain things, right? That's really where proxy information is very important, okay? For example, let me give you a real life example. I can't quote this particular company's name, but this particular company was doing a migration from on-premise, like most of you are doing or have done, to the cloud. And one of the things they realized is that because they had bought something I suggested to you just now, an energy package. So they bought basically a maximum amount of energy that the basically cloud service provider would provide for them. They were therefore unable to tell which exact servers were used at each exact point for their operations. In other words, it could be any one of the many types of servers that particular cloud service provider uses. So that's a data gap, right? Because you don't know which server, so you can't calculate the actual energy consumption, and you can't capture the actual carbon emission. You can capture the maximum amount, but you can't capture on a real-time basis the exact amount. So what they did was they went to have a chat with their particular cloud service provider, and they managed to find out what was the most popular model used by their cloud service provider in their particular region, right? So even though it's not 100% of the time that that particular model may be used, getting information like this will allow you to approximate, right, the carbon footprint being basically produced by your downstream, which would be the cloud service providers. Okay, so that's one. Second thing is, I'd like to challenge the whole team, since we are in this process of really cutting digital carbon emissions, to look at things from a quarterly basis, right? So you have quarterly audits and have a goal, right? 5%, 10%, whatever you think is manageable, have that goal and have a quarterly audit. So there has been people asking me before, why not an annual audit, right? Why a quarterly audit? Or why not something like a monthly audit? The truth is because if you really want to do things really detailed, right? Like we do, like the twinning that I talked to you about, reimagining how work from home, how the devices in a work from home setting will be similar to, for example, the office, things like that, right? Monthly audits are going to be incredibly difficult due to the amount of data points that you need to collect. And one thing that I didn't bring up just now that I want to emphasize right now is that when you calculate the energy consumed from devices at home, you need to ask your employee each time you make those calculations if they had changed their computer, right? Because a lot of times when we measure carbon for our employees who are in a work from home setting, right, they are not obliged to tell us if they change their phone or if they change their computer. They can be using whichever device they want at home. And if they made those changes, but we did not ask them, and they naturally sometimes wouldn't tell us, then what happens is that our calculations will just go off the cuff, right? It won't be as accurate as it should have been, right? In the office, it's much simpler. If you get a new set of computers, you know you've got a new set of computers, very straightforward. But for your employees, it's very important to A, check if they got a new computer, or B, if they have more than one computer, which one they're using most of the time, right? Because in some instances previously as well, we have seen situations where we've got employees who had multiple setups at home. And so there was a need to really check in which setup they were using. Yes, Alicia, I see we've got a question.
Yes. Is this more like important for people that work from home like consistently? Like just like this evening, I'm at home. It's about 9:30 where I live PM. So I obviously took my computer home with me to do work. Like if people just kind of add on to work, how important would that be to track and to ask them about?
Definitely. That's an amazing question, Alicia. And I guess you're really thinking real forward thinking right there. So great job with that question. The answer is threefold. Okay. So right now, there are, I'd say broadly, three types of companies. The fully work from office companies, unfortunately, they're still around nowadays, the fully work from office. And I guess that wouldn't be a problem. Yeah. There is the fully work from home one, in which that would also not be a problem because you'll just know that to focus on your employees who are working from home. And there's the middle ground, the one you're talking about, right? Even in the middle ground, we see a spectrum. And what we see is that it would be key to find out about employees' devices if there is a structured hybrid working, what that means. So if the company's policy is 3 days in office, 2 days at home, then we know there's a 3-2 split, right? So that would be key for you to measure your employees' work from home energy consumption, the device, the carbon footprint. If it's an occasional one-off, sometimes your employees, perhaps the parent calls in sick, they need to be at home to look after an ill parent for 1 day, and in the whole month that's just 1 day, then it would be less relevant in that extent. So what we do always is we first look at company policy, and then we filter down from there as to the relevance of work from home carbon emissions. Is it structured? If it is, then it becomes more relevant, and we actually have a ratio to calculate that with. If it's unstructured, which is for example, the parent falls sick, the kid falls ill, kind of situation, then for those we can actually greatly reduce the weightage of at-home digital carbon emissions. One small caveat though is that it actually also has links with company culture and employee culture. This is something we've found out before, because in the past we've got cases whereby we have two companies, similar companies, and what happened was that in one company, both they were unstructured, by the way, so they essentially had to work from office in all times unless they couldn't, and then there would be like a kind of like procedure whereby they could apply to work from home for a short period of time. So we've got one company in which due to company culture, people never wanted to work from home at all, even if they could, right? And another one in which was very loose, even though it's unstructured, and people were applying to work from home for a variety of reasons more often. So based on that, right, company culture does affect this, but that would be really advanced stage stuff, right? So you're at a good place right now, but like, I mean, like maybe like for next year or the year after, if there is interest in the area and like people in the credit union are like, we want to do more, then these are things to analyze. Company culture, how that affects the amount of work from home, and does that translate to more or less digital carbon emissions? I hope that answers your question.
It did, and it's really helpful, and it reminded me that's something I can look into. Is right now we're filling a lot of positions, but we're prospecting building a new branch on one of our locations, so because we run out of space. So there is a real possibility some people will be working from home. So that's something that I'll definitely try to make as part of the discovery process, is what people are going to use when they do that for our emissions. Thank you.
But yeah, pleasure is mine, Alicia. And one thing for everyone else, for Donnie and Hazel, Cassie and Katie as well, and of course Alicia, and everyone who watches this session, is that there's actually what we call the third home. Okay, the third home. So this is something, if you guys want to really do advanced stuff right now, I'm really pushing you guys to it. Advanced stuff. We need to look at the third home. So what on earth is a third home, right? So if the first home is where you're at right now, the second home is the office, the third home could be a co-working space. So this sometimes happens for institutions, for example, like credit unions, whereby if there is a new branch or if there's an office renovation, a portion of the staff won't be sent to work from home, but rather from a co-working space. So they still have that in-person interaction, collaboration, brainstorming. And in that instance, it's very critical to understand if they are using the co-working space facilities. Because sometimes, for some companies that understand, if they don't provide laptops, but they provide desktops, what happens is that they will therefore use the co-working space desktops instead, and that would be a different kind of carbon emission calculation as well, right? So that these are things that you need to pay attention to. When we talk about really advanced things, when we consider work from home, we also do consider things like if they are generally speaking working from their own home. Sometimes they work from their parents' home. Sometimes they work from a partner's home, right? So these are things to also bear in mind. Nitty-gritty stuff, but when they add up, right, you can actually have a vastly different picture if we don't pick these things up correctly, right? So the third home, for any one of you who want to write that down, right? Very, very important things, especially for data collection. Okay, so where was I? Takeaways, yes, quarterly audits, and let's talk about collaboration, right? So collaboration is important from one aspect, right? So of course, when you're competing as credit unions for clients, collaboration may or may not work out, right? For some information, but for ESG information, collaboration is key, right? And why do I say that? Because a lot of times, if you can find, especially if you can find a similar size organization, could be a credit union, or it could be an adjacent industry with similar attributes as a credit union organization, right? Then you can actually benchmark ESG numbers. If internally your numbers look far worse or far better than others, it's time to have a deeper look as to your data collection and your data processing, right? Because a lot of times we've seen that when these benchmarkings are done, especially if you've got 3 or 4 similar organizations and your numbers are vastly different, even though you're doing the same things, that may indicate problems with data collection. And that's one of the retroactive ways to find data problems, right? So retroactive data collection solutions, one of them would be here, collaboration, benchmarking, right? If your numbers are too good to be true, unfortunately, they probably are. Okay, so this is one of the things. Insights, right? So insights, I guess it's essentially best practices. All of us are here on today's call because we want to do something for digital sustainability, for the world, for our children, right? It's really amazing. And so insight sharing, usually we've seen across the board, people more than happy to share with you what best practices they have. Sometimes if you're having problems collecting data, they might even give you some insights as to how data can be collected given your particular scenario, right? So very, very helpful things right here. Okay, so the next thing I want to talk about is sustainability roadmaps, right? Okay, so I've got data right now. What do I do with the data? How do I make use of this data? That's where the roadmap comes in. And it's actually 5 parts, right? Pretty standard, but I want to go through with you each part still. The first part here is assessment. So assessment means data collection. That's done, right? So we've assessed the data. It looks fairly okay. Your numbers aren't terribly worse than people in your vicinity. They aren't much better. They're good and they're about there, right? So we've got assessment done. The next part really is goal setting. And this part here is key, okay? It's key for 2 reasons. The first thing is because it sets the tempo for your vendors, okay? So this is one, right? Especially if you have more than one downstream vendor, your scope 3 emissions can be pretty significant, okay? It can be amplified. So the carbon emissions of your vendors become your carbon emissions per se through scope 3 calculations. And therefore you need to set goals not just for yourself, but for them. Let me repeat. The goal setting shouldn't just be for yourself, but for your vendors as well. Because when you eventually do ESG reporting, you need to write your scope 3 emissions. And if your vendors aren't doing very much in this space, you will be directly impacted, right? So ensure that the goals are clear, they are measurable, and they basically should aim to reduce carbon emissions by a certain percentage, right? One of the things that we talk about in goal setting here is green procurement, right? So there's an entirely huge topic on itself, but I want to touch briefly on it, right? So increasingly so, green procurement is becoming a benchmark amongst companies, especially financial institutions. Because in-house, there is just that much we can do. Donnie mentioned he has virtual machines. Alicia mentioned that they're in the process and doing well. and Hazel's also in the process and doing well. But there will come a time where you will realize that the amount we can do in-house as a credit union has its limits. So we will go better and better and better, and then we'll hit that plateau, right? Generally in about 2-3 years. What happens next, right? And that's really where goal setting for your vendors will be key to your success. So that's number 2. Strategy, right? So strategy always have a short term, medium term, and long term. How digital sustainability is a bit different is that short term is usually in-house. So we fix ourselves. Medium term is usually a mixture of in-house and out-house, right? So in-house, carbon emissions, the remaining bits, and out-house. And long-term, generally speaking, is structural, which means that it is looking at your vendor. So strategy differs short, medium, and long. Short, generally in-house. Medium is a mix of in and out-house. Long-term, generally, how do you nudge your vendors to do more? Implementation, this is very much in terms of stakeholder management. How do we ensure that this is something important to management as well? So they will basically have more resources into this. And last but not least, monitoring. Monitoring is incredibly important because it has to be a system. If you don't have a system to monitor it now, my advice for you is to start building one, right? When I talk about systems building, we're not talking about some fancy dashboard or fancy expensive $1 million systems you buy from cloud service providers, right? We're talking really about a monitoring system as to what you'll do every month of the every day of the month, every month of the year, what information will come in when, how do we know we're on target, how do you know we need to make some changes, right? So that kind of monitoring system. So key considerations, right? Budget-wise, it really depends on where you are and which stage you're at right now. For us, for companies that are just at the beginning of the journey, we would actually advise them 10 to 50,000 per annum just to kickstart the entire process. Of course, it depends on how deep they want to go, and of course, the size of the organization and how deep they want to decarbonize their infrastructure. Leadership buy-in is incredibly important. It's essential for momentum, right? And right now, I'm not sure about your sites, but right now, in many areas that we in GreenieWeb service, we're seeing how leadership buy-in is very critical, right? Especially when political landscapes change. One of the things we realize is that leadership buy-in is essential for continuity of projects, right? Let me just say that again. When a political landscape changes, leadership buy-in is critical for continuity of projects, meaning that when the incentives that are provided by government start being reduced, we need leadership buy-in to continue sailing the boat when we need it the most. So regulations right here are something that you can look at. SEC ESG rules disclosure, 2024 version in the United States. In Europe, there's something called CBAM, C-B-A-M. No, it's not the latest hit word in a club. It actually means cross-border adjustment mechanism, right? So CBAM stands for cross-border adjustment mechanism. And it basically means that if you are servicing clients in Europe, right? If you happen to have clients in Europe, you know about CBAM, because CBAM basically means that if you are polluting more, or if you are in an area with less stringent environmental regulations, you might have to pay an environmental tax, right? For technically not doing enough to access clients in Europe, right? So CBAM, cross-border adjustment mechanism, big thing for the whole of European Union, and in the US, we've got the SEC ESG rules. So plan these in mind. The budget really needs to cover everything. And how you get leadership buy-in? Well, I put this right after leadership buy-in is because regulations generally compel leaders to do something, right? Otherwise, they would be in breach of compliance, and it's very it makes things very difficult from a government's point of view from them, right? So you are helping the leader achieve compliance, right? And that's why they need to grant you the resources to do that. Okay, so In terms of short-term initiatives, right? One of the things that we talk a lot about is getting our house in order. And first things first, green policies. Yeah. So we've got policies for HR, we've got policies for almost every other thing in the company. But one of the things we realize that institutions, including financial institutions, don't have is we don't have it in black and white, a green policy. And this is something usually that can start from the top down. Earth Hour is 22nd of March. Earth Day is 22nd April. Maybe it's a good time to start floating these ideas with leadership. Have a green policy, right? Meaning that it's a set of rules, or if rules are a bit too tough, then a set of guidelines that every employee, including new hires, need to know and need to work by, right? I use here duplex printing as a very, I would say, simple example. So essentially print on both sides of the paper. That's something that is done generally for economical reasons rather than green reasons. But if we take that thinking and that kind of rules and policy, company policy to print on both sides of the paper instead of one into the digital space, we can see how things can get so much better. Second thing here would be employee sustainability training, right? And this really varies by budget, right? Because some companies may have a bit more budget, some may have less. What we like to talk about really is the internal amplification method, right? And that's really why I'm so glad that today's session is recorded and that all of you are like Alicia, like taking notes, right? Because most of the time we realize that the best form of employee training is not an external service provider, for example, like myself going in and teaching everyone. That's amazing, right? But what's most cost effective for the company is that if one person per company is trained and you be the amplifier, you be the champion in the company. So having a green day or a green half a day, that's incredible. I know of some companies that have what they call the green hour every week, whereby the green hour is whereby the green champion, like yourselves, maybe Bonnie, Hazel, Alicia, where you guys go in and amplify impact. You teach your folks, your peers, one green tip, one green thing they need to do this week, right? And next week there's another green thing, right? So there is that continuity, and it keeps things fresh and interesting. Companies have that green hour also because, at least from what I understand, it's a good way to have company bond building, right? So they use that as a kind of camaraderie inducing event. And that's fantastic in itself. Builds good friendships through that. Recycling programs, we talked a lot about e-waste already, and waste reduction initiatives as well. I just want to point out one thing here, right? When we talk about recycling and waste reduction, and we're going deeper right now into advanced stuff, yeah? So the more basic stuff is, okay, are we recycling our laptops? Are we recycling our printers, right? The more advanced stuff is whereby you start thinking of scope 3 recycling. What do I mean? One of the biggest problems right now globally is the recycling of solar panels, okay? Basically, in the last 20, 30 years, a ton of solar panels were built and were put out there. In the next few years, we will see the first mega wave of decommissioning of solar panels, okay? So basically, it means that if you are using a green service provider right now, you're using a green cloud service provider, a green host right now. You need to, and you could, and I would suggest that you need to start asking them what they are doing about those solar panels, okay? Because that's inherently also part of your value chain as the person who chose them as a vendor, right? At present, unfortunately, it isn't looking too bright. A lot of these these vendors, frankly, haven't have very too concrete of plans of what to do that many solar panels. They may have like plans for a smaller number of solar panels, but these are things that you need to start thinking more of, right? Especially if they are an incredibly boutique niche player and they haven't started thinking of these things yet. So recycling program, not just yours, think of your vendors, especially things like solar as well. And one other point I want to talk about today is that environmental impact, sometimes there's more than one. And that's the reason why you would have heard me talk about hydropower less, right? Hydropower. So one of the, well, less talked about side effects of hydropower when your service provider tells you they're using green energy is that a good number of times hydropower is created through the creation of dams, right? Dams, they dam up an area. And what happens is that they have to flood a highland area, affect the flora and fauna, as well as the livelihoods of people there. So what happens is that when we move away from ESG reporting, and if your company or credit union starts to do what we call impact reporting in the future, then those would also be considered, okay? So when we talk about ESG reporting, we're talking about carbon, energy, data. In the future, if your company decides to amplify the scope and talk about impact reporting, right? Things like the impact of the dams on the livelihoods of the people who were there, the flora and fauna who were there, those would also have to be reflected in your impact report. So if your company may, or the credit union may one day move in that direction, it's important to start having some advanced thinking of those scenarios right now. Okay, medium term. So in the medium term, we're talking about renewable data centers, all right? And there's actually one very interesting thing right now. It's called the tropical data center. So essentially data centers guzzle a lot of energy because of cooling, because they need to keep the temperatures cool, and they need to ensure that all of their infrastructure doesn't overheat, right? So what's happening is that we need to really ensure that even the data centers that we choose are some of the more sustainable ones. For example, like tropical data centers, and there's actually experimental data centers that are put in the ocean. So they put the data center itself, literally the whole data center, in the sea, right? They started piloting that, I think, in Europe, in Western or Northern Europe, and that's something very interesting to look at. Paperless onboarding, I think all of you have got that cut out, or rather got that done well. Automated e-statements as well. Digital lending workflows, also part of the same story. Okay, so medium-term initiatives. And long-term, really, as I mentioned, green procurement, that's very important. We haven't quite talked about this, but I want to talk about this right now. So green procurement, I've talked about. Scope 3 emissions, both in terms of nudging your vendors to clarify their energy use, as well as to look at their e-waste solutions if they're using solar panels are big things. But there's this huge arrow here, right? Like huge arrow here for green lending, and it's not by accident, right? It's not a design thing. I actually put the arrow like a super long arrow here. Why? Because one of the biggest carbon, I would say, amounts of carbon from scope 3 for credit institutions like yourselves would be what we call finance emissions. Okay, finance emissions. So this is a term that you may have heard before. For those who may be less familiar, finance refer to the carbon emissions that come from activities you lend money to. For example, if you lend money to an oil and gas plant, right? The oil and gas plant is built because of the money you lend to them. Therefore, you have financed the oil and gas plant. And so the carbon that comes from the oil and gas plant becomes your carbon, and that is called finance emissions. It's very unique to the financial industry and to credit unions like yourselves, because no other industry actively lends people money, right? So only your industry does. And so credit unions also has finance emissions, right? It may be a slightly smaller problem for credit unions because the majority of clientele for credit unions would be small business owners, right? Maybe someone who runs the laundromat, things like that. So it may be a smaller issue, but you still need to take note, right? Because sometimes, I'd say for small scale, even like small scale, I'd say small scale mining activities, or small scale agricultural activities, or small scale activities that may be slightly more pollutive in nature. Those may tap on what we call syndicated loans, which is basically they go to a few credit unions and they take some money from each, right? So you would still be financing potentially the building of a small mine, right? And that would be your finance emissions. So finance emissions are one of the biggest issues for financial institutions, simply because they are upstream. What do I mean? It's far easier to tell your vendor, a cloud service provider, that I want you to go green or else I won't give you the contract the next time. But if you're going to your client and you're telling them to stop mining, even though that's their core business, that's very, very difficult. And that's why I put a super long arrow here, because it's a super long-term initiative. You need to start having those conversations with your particular clients. And one of the things that people like to talk about, and this is another term, right? So there's finance emissions. There's another term called transition financing, right? So transition financing essentially is if your client is in a sector that's deeply pollutive, for example, oil and gas, small scale oil and gas, small scale mining, things like that, right? Then what happens is that transitional financing, even from credit unions, come about because you finance that transition from, for example, oil and gas into hydrogen, right? For example, from the automotive industry into EVs, electric vehicles. So when you do that, they are technically still in the same industry, but they have transited from a more pollutive version of the industry to a less pollutive version of the industry. So transitional finance can help reduce financed emissions. So because you're now financing the transition, so in the end state, they will pollute less, and so your finance emission drops as a result, right? So these are some long-term kind of initiatives to think of that will be incredibly beneficial to all of you. Okay, so I'll wrap up for session 3 is that sustainability roadmaps are multi-phase. You've got short-term, medium-term, long-term. And what you really want to do is here, right? You want to bridge data gaps, right? And you want to really measure the impact and therefore have those plans to accelerate action. Before we go to the next segment, just like to check if we're all good, if everyone's still hanging in there. Everyone good? Give me a nice Alicia. Hi, Hazel. Everyone good? Give me an emoji. Okay, fantastic. Thank you, Cassie and Katie. Okay, so if we are all good, then I'm going to go on to the next session. Yes, we still have a next session. And if at any point in time you want to use the washroom or anything, just head out. Thank you, Donnie, for the response as well. Because we are running out of time. I don't want to keep you too late into the night, though we are all eco-warriors. But I want to make sure we get through roadmaps, right? Before we wrap up in the next half an hour. Okay, so sustainability roadmaps. And what we want to talk about really is how do you create a roadmap that drives efficiency, right? That has that ROI, that builds trust with your leaders and allow it to support long-term growth, meaning that this system that you have created, that Alicia, that Hazel, that Donnie, that Katie and Cassie, that you've created will last for many years to come. Because we are at a very interesting juncture right now that for the first time in many of our companies, we are the first or the first few in our departments. So we have that say as to how the organization will run this department for the next 10 years or longer. It is based on what we built right now. And that's why the roadmap isn't really just a roadmap. It's the legacy we leave behind in our particular institutions. So what you want to do is really look at this very critically. And we're just going to go to the next slide. And we're going to talk about engaging stakeholders, yeah? Because sustainability is important. We need everyone on board. So one of the things that we realized is, and you can actually quote Deloitte on this, right? When you talk to your boss, when you talk to your colleagues, is that there is actually a 15% ROI increase. So you have a return on investment. That's what ROI stands for. And you have a 15% return on investment via efficiency and a 25% brand lift, right? So what does that mean? And I think this is very critical for credit unions, right? Because when we think of lending to the community, we think of lending to folks that we know, folks in our area. And more than that, we're also thinking of lending to the next generation of business owners, right? The next generation of small business owners. And what we see is that a lot of them actually are fairly mission conscious, fairly, I would say, environmentally conscious. And so when we do have ESG input into our systems, it's actually a better sell for them to be our client, right? So that's where brand lift comes in, right? 25% brand lift. And then when we talk of efficiency, we're really thinking of how when we do things like low carbon computer coding, right? We use less energy, we pay less money for energy bills. There is that return in financial investment. Harvard Business Review, HBR, our dear friends at Harvard, did a very interesting study as well. And they talk really about how teams can accelerate the adoption of green initiatives, right? So if you have stakeholder buy-in, they see that teams whereby management is essentially bought in, colleagues are bought in, progress is faster, but up to 30%, right? So it's very, very important to really have the internal cognition and the internal synergy when trying to run such a program. Okay, so let's go to the next slide. And this is about the drafting of goals. We unfortunately have less time, but I still want all of you to do this because I find this very, very, very important, right? So the first thing I want to talk about is SMART. So what is SMART? SMART means specific, measurable, achievable, relevant, time-bound, right? So if you guys don't have it there, please write it down. All your goals, at least those that relate to ESG, has to be SMART. Even non-ESG goals technically should be SMART. And basically it means that A, it has to be specific, meaning that you don't say we want to reduce carbon emissions by 10%. You say instead, we want to reduce carbon emissions that come from our work from home employees' devices by 10%, right? So it shows you who the stakeholder is and where the savings will come from, right? And that's really step one to having a successful goal, is to know who should be the one implementing and where the results will come from. And that's why being specific is very important, because if it's vague, everyone will assume someone else will do it. And at the end of the day, no one does it, right? Which is a problem. So that's number one. Number two is essentially measurable. So how do you measure it? So this charts back to the goals, to the data collection we were talking about just now. If something is clearly measurable, use that as your SMART goal. Never, and this is a huge red flag, right? Never use something you currently cannot measure as your SMART goal, right? Because if you cannot measure it, chances are whoever else who needs to measure it cannot measure it, and they will use that as an excuse to not measure it, right? I know it sounds like a tongue twister, right? But essentially, if you can't measure it, they won't, and they will use that as an excuse to never do so, okay? So that's two. Number three, achievable, right? I know we are all high achievers here. The very fact that you're in this session and the very fact that you're doing something means that you're looking to achieve something, right? Achievable is not just for us. We must make sure the goals are achievable for our peers who may have to be involved, right? We have to also empathize that for some of them, this would be an additional task for them, something they sometimes may not be very willing to do. And so when we talk about achievable tasks, it has to be bite-sized achievements that they can celebrate as well. And this jives in so neatly with the next one, relevance, right? When you create a SMART goal, ensure that it is relevant as best as possible to the KPIs of whoever is achieving it. Let me repeat that. When you create a SMART goal, ensure that it is relevant to the KPIs of whoever needs to achieve that. Meaning that if the person implementing that is your colleague, try your best to give them a SMART goal that is relevant to their KPI. It makes things so much easier for them to work at without feeling like an additional burden. Last but not least, time-bound, right? So we all understand the urgency of the climate situation. That's why we're here, thankfully. And it is critical that we work with haste. Yeah, but whenever we're pushing for different things to be on the table, we also need to understand that priorities may differ individual by individual. So when you have a SMART goal, always ensure you have a range for the time limit, right? Ensure the time limit is in a range. It should not be a specific number, but rather a small range. So what that means is that even if that personnel has to shift around his or her priorities, they can still get it done within that range of time instead of a specific deadline per se. Okay, so with that in mind, I hope that all of you can just take this time to write 3 short SMART goals, 2 or 3 SMART goals, and I just want to hear from you all what your SMART goals are, right? So just now we had Alicia, Hazel, and Donnie. So now let's try in reverse order. Perhaps we'll start with Donnie. Donnie, if you're still there, what might be 2 or 3 SMART goals that you would have for digital sustainability when you go back to the office tomorrow? Donnie, if you're there.
Yes, I'm there. To reduce the budget allotted to, like, for example, paper by 25% for by the of 20, by the end of let's say the second quarter of 2025.
Okay. Okay, that's very, very interesting. Might there be one last SMART goal that you will have?
Okay. To reduce the overall electric consumption at a specific branch, branch A, by 50% by the end of 2025 with the implementation of solar panels.
Right. That's incredible. Thank you, Donnie, and a big round of applause to you. Right, fantastic. So what I really liked about what Donnie said was how he wanted to have ambitious goals. He said 50%. It was specific. He mentioned branch A, specific branch, and he talked about overall energy consumption, right? Which would basically be measurable because you look at your utility bills, you know how much a certain branch basically uses in a certain time. And he talked about time bound by the end of 2025. So he's giving that leeway, right? People can achieve that before, or at worst case, they still have until the end of the year. So fantastic. Donnie, thank you for that. And perhaps Hazel, if you'd like to give us next try at this 2 or 3 SMART goals when you're back in the office next week. Oops, Hazel, you're on mute. And Donnie, I might have to mute you a short bit. Okay, Hazel, you're mute.
I'm different. I'm on the board. I'm not within the environment of the credit unions, but it's to raise awareness for me with especially the board that I'm on for decarbonization, like overall, everything we have discussed. I just think I have to get people thinking about it more seriously. We're not using it every day, not using devices every day, but we're not realizing the impact and how important it is for our credit unions, and they need to know this information. They need to be supportive and encouraging.
And that's a fantastic SMART goal. I mean, thank you so much, Hazel, for that, because it really brings us to why we are here in the first place, awareness raising. And I think as much as I talk so much about cutting energy usage, employing advanced techniques, thinking about twins, right? What you mentioned, Hazel, is incredibly true. that people first need to know that it exists, right? That technology has, well, a non-green side, and that we need to do something about that. Because more often than not, we realize through many interactions across the board that it is very, very, I would say, it's very much taken for granted that technology means going greener, right? We were all raised up in that environment where the messaging media was that when you go digital, you go green, right? So when we tell people that going digital isn't going green, we get the very surprised expression. And so very big kudos to you, Hazel, for having that SMART goal. It is specific. I guess measurable can be seen when they finally ask you if their laptops are using more electricity than it should be. And indeed, something achievable, relevant, and time-bound. Right? So congratulations to you, Hazel. I think that's a good SMART goal. Mike, you have one more.
Well, for me, I know I am very guilty of just using different devices and not being smart about where I'm storing my information and how I can do less.
Okay.
I have
Do more
to be
with
better
less.
at doing less.
Yes, so thank you so much, Hazel. That's very true. And I guess the main thing about digital sustainability is how we don't just do less, but we can do more, but with less power, with less
Right,
energy,
yeah.
less data. So fantastic. Congratulations to you. And last but definitely not least, Alicia, I see you've been busy writing notes. So share with me 2 or 3 SMART goals that you want to bring back to the office tomorrow, next week.
Great. So we just got these new printers and they have like a lot of features to help us go paperless. So I'm thinking we could start with using 25% less paper by Q1 of 2026 for all new account applications. So we have some new software that might help us to eliminate some paper with our account openings. That might be a good place to start and kind of set us up for success. I also want to do like a personal one of hosting 10 Earth hours by Q3 with my staff. I think that's really exciting and a good way to get them engaged. And I've learned so much today. I just can't wait to share some of that with them because it's been really interesting. And then the other one I had wrote, I didn't really come up with a timeline, but I would need to engage with some of my coworkers. So hopefully I can get that buy-in that Hazel's looking for as well. But I'd like to do an assessment of how much we've done in financing for solar panels so that maybe we can reach out to those people ahead of that when those start to kind of be decommissioned and make some suggestions on how they can recycle them or reuse them in some way to help with the environmental impact of that.
That's wonderful. That's 3 extremely smart goals to wrap up the sharings by the 3 of yourselves. I really enjoy the level of specificity on your side, Alicia, in terms of who will be the stakeholder, what you want to achieve, and by when, right? And I like even more the fact that they're all addressed at 3 different groups, right? The first one, in terms of usage, is something that's more infrastructural. Your second SMART goal was very much in terms of what you could do, hosting the Earth hours. And the last one would be something more external, what your clients could potentially do. Right? And this is also a very nice point brought up, right? That solar panels might be something that credit unions might also give credit for, right? Or in that sense, lend credit for, make loans for. The small business owners who want to put a solar panel on top of their ranch, on top of their small eco home hotels, and on top of their homes, right? All of which will take loans for those solar panels. And what happens to those solar panels once they're decommissioned, right? Is there a plan for that? I think those are very fertile grounds for future conversations with them as well. Okay, so we've had this sharing, and really, I guess I chose this picture because first, this guy looks like he's in Christmas, and I think one of the reasons why I chose this picture is because of these 8 steps, right? And if you've got a phone or if you want to take it down, feel free to do so, right? It really helps when we talk about peer-to-peer feedback, okay? Because a lot of times when we talk about sustainability roadmaps, it's a team effort. It cannot just be us pushing. We need the board, we need management, we need our colleagues, we need folks who work together with us on our teams. We need some of our subordinates to also work together on this. And it always starts, therefore, with company culture. What is the existing company culture? This is specific to each credit union, and it really also is a big factor in determining the success of the program. Soft skills, very, very important right here. I wouldn't say you need to do a personality test. If you do know the personality of your colleagues, that would be fantastic. Nudge them in the right ways to get their buy-in, right? Expectations need to be very clearly set, especially when we're talking about ESG goals. What is it that we want them to achieve, right? So when I come back in 1 year's time, right? Or when you come back in 1 year's time, when it's Christmas time, end of the year, how would they be behaving differently? Provide them different channels as well. Sometimes we might say, hey, this person needs to do this, right? But if it's very difficult for him, could we provide 3 things he could do such that even if he can't do one, he can do the other 2, right? Or he can pick from one of the 3. These are things that we want to really impress upon people. Because a lot of times I realize that when some companies create sustainability roadmaps, it's very much like personnel A should do A, right? Like, for example, personnel A should reduce the coal financing of the financial institution by 10% before Q4 2025. But a better alternative could very well be personnel A should increase transitional financing to coal companies transiting out of coal by 10%, right? It's something that people can do and it's within their grasp. It might be a different channel, but the impact is the same. Always provide regular opportunities for feedback. That's very important. This one, number 6, would be perhaps the most important part of these 8 steps, right? Why? It's because sometimes we've seen some organizations that eventually fail, right? They fail in their ESG plan is because there was internal resistance. And that internal resistance kept snowballing, but was never ever realized by the champion like yourselves. So by the time they realize it, it's going to be in a very terrible place where there is a lot of misunderstanding, unhappiness, and pushback. So if you forget these 8 steps, just remember, give people an opportunity to provide feedback as and when you implement this, right? Because ESG changes are one of the largest and most complex organizational changes any organization can have. And when we talk about a digital sustainability change, that's like king of the hill, right? Because you're changing both the digital world and the ESG world at the same time. So you're doing 2 mega things at the same time. I wouldn't be surprised if some people felt a bit uncomfortable going through that. And therefore, we need to provide them with an outlet for feedback. Only when they buy in can the organization succeed. Okay, so if we had more time, I actually would have like run through some a very cute example of a credit union, hypothetically giving strategy results and ask you guys to kind of like brainstorm. But essentially, this is a very nice hypothetical, right? I just run through what I was thinking of when I came up with the hypothetical. So credit union, I call it Allianz Credit Union. So the challenge is that they had high service emissions. It might be a challenge for some of your colleagues who may not be on call here today, you know, some of the other credit unions around the world who still have their own server rooms. They might actually have incredibly high server emissions, right? Because the servers are old and there are tons of them. And so one of the strategies would be, for example, moving to Google Cloud, training the staff to also use green IT. And then the results could very much be emissions drop, savings, and member growth. Okay, so this part, I want to talk a bit more results, right? Because at the end of the year, or maybe like whenever the end of the financial year is, people in management will come to you. They'll come to you, Hazel. They come to you, Donnie. They'll come to you, Alicia. And they will ask you, what have you achieved? Okay, if you tell them you have SMART goals, you've got a roadmap, you've got guidelines, they will be like, cool, but what more? So you need to quantify ESG wins in non-ESG terms. Let me say that again. You need to quantify ESG wins in non-ESG terms. What do I mean? I mean that you need to talk about ESG wins primarily, number one, in terms of finance. How much have you saved? How much energy bills have you saved? How much data bills have you saved? Things like that. That would immediately get buy-in from management because you save money, right? Money saved there means money for everyone, right? Or also they think sometimes. And the next thing you need to talk about is increase in clients, right? Either increase in number of clients or increase in deal size per client. We talked a lot about how Gen Zs are starting small businesses. They're also going to credit unions. They're trying to get loans, right? Did that lead to an increase in membership growth, right? And then we talk about energy savings, right? And last but definitely not least, we then talk about carbon. Because a lot of times unless your credit union is very pro-green, meaning that they are a maverick in the industry for green growth, chances are traditional non-ESG metrics will still matter the most for them. In that case, we need to speak their language to allow them to give us continual support for the years. And that's why when you talk about KPIs, what you achieve, always prioritize financial gains, energy gains, data gains, and last but not least, carbon gains, right? Even when you're talking about carbon gains, always pitch it with a PR angle. Meaning, don't say we saved 75% carbon emissions. Say that we saved 75 trees, and that 75 trees are put on our brochure that is sent to Gen Zs who would like to get a credit loan from us, right? So there must be that marketing PR angle that accompanies the green angle to allow management to have greater buy-in. We see that overall, anecdotally, it's about 7 times more effective when you target or when you peg your green emission drop to a marketing angle. Yeah, I'm not in any way encouraging greenwashing. Let me say that again. I'm not encouraging greenwashing, but I just want to make sure that when you report what you achieve to your to management, to the board, that they understand truly what that means. Because if you tell them we save 200,000 tons of carbon, generally speaking, most management who I've talked to cannot quite understand what that means. They bounce between thinking that's a humongous number to thinking that that's a very small number. Why did you just save 200,000 tons of carbon? Why not 2 million or 200 million, right? So because they cannot quite visualize, you need to plug in the marketing angle for them to appreciate your savings and to give you continued support for your programs, okay? So ending off, case studies, some lessons learned. When you do a server switch, for those who haven't, that's technically a quick win. Although I put this in inverted commas, I guess I forgot to put an inverted comma here. It's a relative quick win in the sense that it's easier to do to switch to the cloud compared to all the other things like low carbon computer coding. But it's not like instantaneous. You cannot switch to the cloud tomorrow. There is still a process to it. Yeah. Other things that you can look at in terms of data gaps, address them, or else they will slow progress. And as always, staff habits need to change. Okay, so we won't go through questions, and let's talk about key takeaways. Action plan. Action plan. What will you do tomorrow? Okay, so number one, measurement, right? Measure, and the keyword here is continuously. Okay, so always measure continuously to identify trends. Okay, so this one, it's also very important. So a lot of times you say measure continuously to identify trends. It sounds very like simple, plain, logical, right? But I want to say that one more time. Measure continuously to identify trends. Why? Trend identification is very important in the ESG world because it actually showcases to you the change, right, in your client composition. Let me repeat that again. ESG trends, especially when you measure finance emissions, can actually show you the change in your clientele composition from perhaps maybe very traditional industries, which are to some extent fairly pollutive, oil and gas, mining, lumber, timber, etc., to perhaps more industries, right? Restaurants, maybe ecotourism, things like that. So from this trend, right, you can actually also feed back into the system as to the types of financing that you can provide for them, right? Because sometimes some people don't quite realize, or rather like it's not that intuitive, right, to think of the composition of your clientele, right? And one of the signals that comes in is from emissions, right? If they're moving from a high emission industry to a low emission, it actually means that the per capita financial standing of your client technically has improved, which means that you can potentially sell them certain products that you previously couldn't have. So these are just like some takeaways that I had from other financial based clients. Okay, engage stakeholders, always rally the staff, integrate ESG throughout your particular institution. Okay, so after this, I know we wrote the SMART goals just now, but after this, the immediate next step is write one action you'll do tomorrow. Is it turning off the printer? No, don't do that. Is it talking to your boss to really, or talking to the board to have to set a date for an e-meet or physical meet to talk about this? Is it finding out what is the number of people who work from home or on a weekly basis? Is it finding the number of servers or the models of the servers that you use in your virtual machines? Write one action that you'll do. And essentially, I don't need you to tell me what you want to do, but I want you to commit that you'll do it tomorrow, right? Even if it's raining, even if, I don't know, even if you feel a bit grumpy tomorrow, that you will go and you will find what is the model of the server that is in your server room, or that you will go and send that email to the board to tell them that, hey, there's this very interesting thing. Let's have a discussion. These are the suggested dates. Can we slot one of them down for that, right? Why it matters is because, once again, I like to go back to the HBR, Harvard Business Review. Small steps spark a big change, right? In Singapore, where I'm from, there's a very famous saying from long ago that a journey of 1,000 miles starts from a single step. So by doing that one action, writing it down now and doing it tomorrow, you're going to spark a long journey in your companies. Okay, so in closing, thank you so much, Alicia, Hazel, Donnie, of course, Cassie and KD. You've been one of the best audiences I've had virtually. Thank you for being very engaged throughout today's session, for asking those wonderful questions, and for really being here, not just for yourselves, but for the planet, for the future. Right? I'm just going to end this time now, thanking all of you with a clap from my side. And if any of you have any questions, I would love to take them right now. Thank you so much. Yes, Alicia.
When we were talking about green, I think I might have mixed up two things that we were talking about. One of them was green hosting. Can you tell me what that was again, what green hosting is?
Most of it. So green hosting is choosing who hosts your website. So when you buy your website's name, generally speaking, there will be someone who will host the page. Hosting of the page means that it can therefore be seen on the internet. Like there is that virtual home that the website lives, so that when you Google search it, you can find the web page. So that's what a hosting is. A green host is one who uses renewable energy to put your website onto the internet, right? Because the placement of the internet and the maintenance of the placement of the website and the maintenance of the website requires energy. So green hosts will use renewable sources of power. Non-green hosts will use the cheapest possible source of power they can find.
I think I was mixing up that term with something else that we were discussing, and we invest in something called bullfrog power. Are you familiar with them? I think that's
Could you share a bit more? Yeah.
Bullfrog. Yeah, I think we're purchasing carbon offsets. Is that like a valuable way? Like, is that a valuable use of our money when it comes to like our budget for ESG and sustainability by giving them?
So that's an incredible question as well. Thank you, Alicia. And I haven't talked much of carbon offsets today, and I think this is a great way to wrap up our discussion. So most of the conversations that we've had today, and in the first webinar, was on reduction. So there's actually what we call the environmental hierarchy. Okay, so just like I don't know if you play cards, there's the ace and the joker and what have you. In environment, there is a king as well. The king is actually reduction. Reduction being what we've talked about today, actively reducing the amount of energy, the amount of data, the amount of carbon, right? And that's where we, and me personally, would suggest you spending the bulk, if not all of your budget at the beginning, right? At the beginning, okay? And that's really because if you spend money, okay, so now let's talk about what offsets are. Offsets are an instrument that could be on paper or in reality. Let me clarify what I've just said. And in reality, offset is whereby you pay, for example, a certain service provider X amount of money, and they will go and plant a tree. Okay, so essentially, if you buy 10 trees, then you plant 10 trees, and the tree hopefully will take in the amount of carbon dioxide that they have calculated it would, and that would offset, in that sense, the carbon you produce. Okay, so that's in reality. The problem with offsets is there have been certain scenarios, situations, I would say, with offsets that are more paper-based. So what that means is that in some places, unfortunately, I could bring an axe and threaten to cut down a tree in my lawn, okay? And I could get someone else, a third party, to come over, and I would tell the third party that because I did not cut down the tree will live for 10 more years, and therefore will take in 10 more years of carbon dioxide, okay? And that is something that has happened very unfortunately, and is a form of on-paper offsets, meaning that the tree technically would be there even if you did not threaten to cut it down, right? But because you threaten to cut it down, the third party can issue you an offset, a carbon credit, that you can take and sell. You may have never had an intention to cut down the tree, but you threatened to cut down the tree, and because you threatened to cut down the tree, someone gave you a piece of paper and you have sold it. So if, for example, my company had bought that offset, it would be in theory useful, but in reality, nothing additional done for the planet. So that's really why when we talk about offsets, they are actually lower in the hierarchy, because reduction is always first, like reduction. And then as your eco journeys, Donnie, Hazel, Alicia, as your eco journeys mature as a company, as a credit union, what you'll see is that reductions start to get harder. Yeah, they won't be impossible, but they'll start to get harder. But it'll come to a point whereby to get that extra bit more of reduction will cost incredible amounts of money. That's when you know you have sort of reached what we call apex reduction. Apex reduction means that you have sort of like reduced to you're almost unable to reduce. And that is generally in the middle, towards the end middle, later stage middle, or the early end stages. Yeah. And in this situation, it would be perhaps more financially prudent to buy a good quality offset. Not the threatened tree cutter guy, but like one who actually plants the tree. Because in that instance, spending a ton of money on a little reduction would make far financially worse sense and far ecologically worse sense than buying a good quality offset by a person who plants a tree, right? Why I caution against offsets, it's not just because there may be some on-paper offsets, but it actually is unfortunately a very convenient way for many companies right now, very many companies. A good number of companies, very unfortunately, and perhaps Hazel, when you talk to the board, they might even raise that up to you. They use that as a quick fix, right? So basically, I don't want to do anything on my servers. I don't want to do anything at all, really, nothing at all. So what I do is I take the ESG budget and I just buy a ton of offsets and I tell people I'm green, okay? That is something that works on paper, but it is, environmentally speaking, one of the most irresponsible things that people can do. Because when you buy an offset, we have to remember we are actually buying into the future of a tree. We are not buying the tree, we are buying into the future of the tree. A lot of times, and there have been instances in the past, whereby trees that were planted to be offsets died before the given number of years they were supposed to be present. So it could have been, and this, if I'm not wrong, was a published case in Australia. They had a farm, offsets farm. So they were planting trees there to get money. Everything very high quality, good stuff. But then there was like some form of natural disaster. I believe there was like a huge hurricane in the area that felled a good number of trees. Then the question therefore lies as to if the trees were all felled, what happens to your offset? Do you have to buy a new offset? What happens to the offset? In theory, you should buy a new offset. But in practice, people don't really buy an offset, a new offset, right? Because that's spending double money, right? And it wasn't me who felled the tree, it was Mother Nature. So when you buy an offset, you must always remember you are not actually buying a tree that is taking in that amount of carbon right now. The tree will take in carbon in the span of X number of years. It's usually set out in the particular offset agreement, in 10 years, in 20 years, in 30 years. The longer the year duration, the higher your internal risk is that the tree will not deliver, because you are buying into the fact that the tree should deliver that amount of carbon reduction, but it may not always be the case. So that's why when we go back to the hierarchy, reduction always comes first. Reduction that is in we can verify. And then we talk about external reductions by our clients, external reductions by our vendors. And last but not least, we buy the right offsets, not the threatened tree cutter guy, but the right offsets, right? And there's actually a whole field in offsets right now that talk about offsets monitoring, basically monitoring the tree for 20, 30 years, but that in itself is additional cost and expense, right? Because you not just need to buy the offset, you need to pay the service providers to monitor the offsets to ensure that the tree is there for like 20, 30 years. So all these are additional costs. And I guess especially when we're talking to the board or talking to leadership about costs, right? Any extra cent that should be saved has to be saved, right? So these are just considerations to take into play when we think of things like offsets. But thank you so much, Alicia, for bringing up that point. I hope Bullfrog is planting new trees or stuff, and perhaps if they haven't been very clear, maybe one of the actionable items tomorrow morning, first thing is to call them and ask them, have you actually planted a new tree?
Oh, I'm on it. Thank you. That was great.
Yeah. All right. So might there be any last questions? Always happy. Yes, and I see Cassie has a beard. Cassie.
Thank you so much, Ian. This was fantastic. As I mentioned in the chat, we do have the recording of the first webinar that Ian did was a little bit more introductory. I wouldn't say too much overlap if that is of interest to you. It is still up on our YouTube channel, but we'll be sending out an email. Hopefully not too late tomorrow, just enough time for our colleagues to edit this video, cut out some of the break time for us. But we'll send that out tomorrow, as well as some other resources for you. We'll copy Ian on that in case you have any last questions for him. But we do hope you enjoyed this session and look forward to receiving your feedback. Thanks so much for hanging in with us, everyone.
Thank you
Have
very
a
much.
great rest of your evenings.
Thanks, everyone.
Thank you,
That was
Cassie.
terrific.
Thanks, Alicia. Thanks,
Ian.
Hazel. Thanks, Katie. Have a great one.